Do you want to invest and save for your future, but you don't know where to start? Do you like the idea of investing, but it all seems super complicated? Do you want to get solid returns that have millions when you retire, but you don't want to pay some fancy Wall Street guy to do it for you? Well, if you answered yes to any of these questions, then this video is for you. In the next 5-ish minutes, I'm going to tell you everything you need to know to start investing today. I'm not going to sell you on a day trading course or some magic trading algorithm to get rich. Instead, I'm going to show you the simple truth of how to invest and be successful in the long run. And that word long run is really important. By you putting money aside now, you're going to give yourself freedom when you're older. Okay, so let's start by walking you through the structure of an investment account and how to use it. So to start, there are a ton of different investment companies. There's Fidelity, there's TD Ameritrade, there's Vanguard, there's Charles Schwab, Robinhood, Public, and many, many others. All these companies will let you buy and sell stocks, ETFs, and index funds. However, some of these apps like Robinhood are focused more on the short-term or day-to-day trading side of investing rather than the long-term. Companies like Fidelity and TD Ameritrade can do short-term trading but are better set up for long-term investing because they don't act as much like gambling apps and because they provide more information on different stocks. For complete transparency, I've personally mainly used Fidelity for the majority of my investing, although I do have some money in a Robinhood account as well. No matter what traditional site you decide to use, aka not Robinhood, the process will be almost identical. So let's pick a company. For this example, we're going to use Fidelity and go to their website. You'll then click on Create Account. Here you'll be given two main columns of options. One will say something like Retirement IRAs, and one will say something like Investments or Investments and Savings. Side note, IRA stands for Individual Retirement Accounts or Individual Retirement Arrangements. So it's kind of funny that they essentially say Retirement Individual Retirement Accounts. Anyway, we need to pick a column to start. The options on the left are going to be tax-preferred accounts, which essentially means that you get tax benefits for saving for retirement because the government wants to encourage that. These accounts have a maximum amount you can put in them each year. You can put up to $6,000 in these tax-preferred retirement accounts each year for most people. If you're a certain age, you can put $7,000, but for pretty much everyone, it's $6,000 a year. If you end up wanting to save more and invest more than $6,000 a year, you can also open an account from a column on the right called a brokerage account. This account, you can put as much money as you want into it. But right now, let's just go to the accounts on the left. Now we've got three options. We've got rollover IRA, Roth IRA, and traditional IRA. Don't worry, I'll explain what each of these accounts mean. To start, if you have money from a company investment account, like a 401k, you can select rollover to move that money into a Roth or a traditional IRA. The rollover name is essentially just referring to the process of bringing the money into the account. But for most people, you'll be looking at these two accounts, Roth IRA and traditional IRA. To decide which to choose, you'll need to think about how much money you're making. If you aren't making a ton of money, you should choose the Roth IRA because you pay taxes before you put your money into the Roth IRA, and it will never be taxed again. It doesn't matter if you put $100 in and the stock goes from $100 to $1,000 and you sell it, you'll never have to pay taxes when you sell it. A traditional IRA is usually used by wealthier people. For a traditional IRA, you don't have to pay taxes when you put the money in, but you're going to have to pay taxes when you take the money out at retirement. So to recap, Roth IRA means you pay taxes before you put it in and then never again, and traditional means you delay paying your taxes on that money until you retire. A Roth IRA is kind of like a cheat code if you're able to save and invest money when you're not making a lot. By this I mean if you're in college or living at home or have any other living arrangement where you aren't having to spend a ton of money on housing or other expenses and you're making, let's say, $10,000 a year, as far as the government is concerned, you are living in abject poverty. And after your tax return, you will owe nothing in taxes. So you can put this untaxed money into your Roth IRA and that money can then grow and grow and grow. And I can hear you saying, whoa, 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 put my money into it. How do I do that? So what you're going to do is you're going to create an account. You click create account. And then let's say you want to pick the Roth IRA. So you're going to go in, you're going to put your personal information in. You'll need things like your birthday, your social security number, and stuff like that. Once you've done that, you'll be able to connect your bank account and move your money from your bank account into your Roth IRA. The money usually takes about a day or two to transfer, but most apps, including Fidelity, will let you trade as soon as you set the money in to transfer. Now I can hear you typing, I don't know how to pick stocks. I can't day trade. How will I ever have the time? Well, the good news is that you don't need to pick stocks or day trade or do anything fancy to get good returns. All you have to do is buy the S&P 500 every month and not touch it. The S&P what? You ask? The S&P 500 or the Standard & Poor's 500 is a basket of stocks from the 500 biggest and most reputable and established companies in the United States. There are two different ways to buy these little baskets of stocks. One way is by buying ETFs, also known as exchange-traded funds, or you can buy index funds. They're both essentially the same thing, but there's a couple of minute differences. For ETFs, you can see the price fluctuate throughout the day, whereas an index fund only posts its price at the end of the day. Both ETFs and index funds have fees for the convenience of them putting all the stocks in the basket for you to use, but index funds' expenses tend to be a little bit lower. All you have to do is check what the expense ratio is. VU, the name of a widely loved ETF, has an expense ratio of 0.03%. So for every $1,000 you buy a VU, you'll have to pay 30 cents a year, which is hardly anything when you consider how much time and effort they save you. Seriously, if you just maxed out your Roth IRA and bought VU or a similar S&P 500 ETF and do nothing else, you will probably make 8% on average a year for the rest of your life. You can even set it to automatically take money out of your paycheck each month and automatically buy the stocks for you so you don't even have to think about it. If you already know the power of compounding interest, you can skip ahead, but it's so important to understand how much of an effect investing and letting your money grow can make. For example, let's say you're 18 and invest $500 a month until you're 65. At 8% interest compounded annually, you will have $2.7 million at the age of 65. If you start investing the same way at 25, you'll only have $1.5 million when you turn 65, and if you start investing at 35, you'll have $679,000 by the time you turn 65. Now remember, the total amount of money you put in for each age was $282,000, $240,000, and $180,000. This means that you made $2.4 million, $1.3 million, and $500,000 for just not touching $6,000 a year. As you can see, starting as young as possible is super important. Imagine what you could do with $2 million extra when you retire. Obviously, if you can buy more and save more in a normal brokerage account, by all means go for it. But I just can't stress how far ahead of the curve you will be if you start saving and investing now. You might be thinking, I don't know how to save any extra money. Well, I've made a video where I compiled 5 easy ways that you can save $300 a month. Feel free to click on that little card and check that video out. So just to make sure you've got it, let's go through the steps. First, select which company you want to use. It doesn't really matter if you choose Fidelity or Vanguard or any other reputable company. Second, open up a Roth IRA if you aren't making a lot of money, or a traditional IRA if you are making more money. Third, transfer the money into the Roth IRA. Fourth, purchase your choice of ETFs. I highly recommend the S&P 500 because over a 30-year period, it's always gone up. Fifth, keep buying in every month. Whether the market is up or down, just let compound interest do its thing. By doing these 5 simple steps, you will set yourself up to have such a great advantage when you're older. I know you guys can do this. Remember, you're awesome, and I'll see you next time.